If the world of investing feels like a confusing, scary mess of terms like options, crypto, and day trading, just know that you are not alone. It's that fear that keeps even the most ambitious people from ever taking that first step. Today, we are going to cut through that noise. I'm going to give you the 3 bucket system that will make investing and building wealth so simple that you can literally start this today. This way is going to be a strategic way to use your money as well as a stress-free way. So let's go ahead and get right into it. The first bucket is what I like to think of as the foundation piece or the stability. This is where your emergency savings is going to be. Now, if you have a steady paycheck, I would recommend doing 3 to 6 months. If you are self-employed or you're like a gig worker or something, I would probably bump that up to 6 to 12 months just to increase that cushion when things are possibly going a little slow. When we are thinking about our emergency fund, this is not about frills. This is your bread and butter budget. What do you need in order to keep your 4 walls and to eat? So that's what you want to do. This is your baseline budget. We're not talking going on trips. We're not talking eating out or anything like that. This is the absolute base. And if you ask me, I'm going to recommend that you put this into a high yield saving account. We are not trying to get rich off of this money, but earning some interest is better than having it sit in your traditional saving account, not doing anything for you. Now, you also do not want this to be easily accessible. And I say that because it can get tempting in times of there's a concert coming to town or a last minute trip or a sale. So you want some distance to it, but you also want to have it accessible that if you need it within 24 to 48 hours, you can get it. This bucket is going to be the one that provides you that peace of mind, that stability, and that foundation for you to start working on bucket number 2. Now, bucket number 2 is where it gets a little bit more fun and more exciting because we've already established ourselves with our foundation and we know that in a rainy day we're going to be taken care of. Bucket number 2 is where we want to grow. We are going to fill that bucket with everything that makes us grow. If we're being completely honest, we know that the traditional savings account at your brick and mortar bank down the street is not going to grow your wealth. It's not going to keep up with the pace of inflation. It's not going to keep up with everyday living. So with your foundation established, we need to start talking investing. And I'm not talking complex investing yet. I'm talking building your long-term wealth over time. Think 10 years out. With it being 10 years, the goal of this is to build that compounding wealth. It's about time in the market and not timing the market. This will be the core of your pivot. It's not about getting rich quick, but again, having that compounding interest over time that will allow you to build wealth. Now, I recommend that when you are working on bucket number 2, you are investing in index funds. Index funds mirror the performance of major indexes like the S&P 500, the Dow Jones Industrial Average, or the NASDAQ. With index funds, you are given a broad range of exposure to the companies that make up those major indices. Mutual funds are similar to index funds, but think of mutual funds as if they come from a company. You buy them from a company. So like your VTIs or your VOOs, which are specifically purchased through Vanguard. Some examples of index funds include your SPY, or QQQ. So you might be asking, how do I actually invest in index funds? Well, you want to have a brokerage account. If you're just starting and you are employed and your employer offers a 401 or any type of retirement plan, that is a good place to start. Do not knock the traditional retirement plan by any means. So your 401ks or your 403bs, or you could start a Roth IRA through a brokerage as well. I recommend starting with a retirement account through your employer or a Roth IRA because these are tax advantages and we are always trying to take advantage of anything we have that will help us grow our wealth over time. Another option, if you're like me and you have long-term goals but you want to be able to access the money before 59 and a half, you can also open a brokerage account through places like Charles Schwab, even Vanguard, Fidelity. They all have brokerage accounts. Now the thing is, when you withdraw the money, if you have any capital gains, that is going to be taxable. But this is good for a long-term goal where you don't need the money immediately, but you want it before age 59 and a half. And before we go any further, let me know, please go with a reputable broker that is regulated through the SEC. And as always, remember, I am not a tax professional or a financial advisor, so consult with your team as needed. One of the most important things is to understand it is about time in the market. It's about consistently investing and dollar cost averaging. This is not going to be where you get rich quick. This is not going to be where you turn $500 into $1 million within a month. It's going to be that slow, steady, consistent investment into your retirement account or to your brokerage account. And you're going to see those returns year after year once you have established some momentum in the market. So your time in the market and dollar cost averaging is going to be the best thing thing that can happen, and that is definitely going to be your friend. And speaking of friends, who does not love a good time? Who does not love a different experience? And that's going to lead us to bucket number 3. Now, bucket number 3 is going to be our fun bucket, and where we get a little more aggressive with our investing. So we've already established that foundation. We have our emergency fund, whether it's 3 to 6 months or 6 to 12 months. And now we are consistently investing. So in bucket number 3, we are able to take about 5 to 10% maybe. I'm not a financial advisor, and put that into some aggressive things like individual stocks. Think your Teslas or your Metas, AMDs, and Nvidia. Doing that in bucket number 3 allows you to increase your exposure and capitalize on some of the fast movers within the market. Now, let me tell you, you want to do this through controlled risk and calculation. You do not want to go all in. You want to research companies. You want to make sure they're good. You want to make sure that they have a good future and growth perspective. In doing this, and we're going with the more aggressive route, over time, you might see a quicker return than what you would normally see in like your 401k or anything like that. And this is where it comes to actively managing your portfolio. I love to actively manage my portfolio. It allows me to capitalize on high returns while minimizing my risk because I take calculated steps. Please do your research. Let me tell you, do not chase fad stocks or meme stocks. Perfect example. Back in 2016 or 17, I bought Snap when it IPO'd. And I think it IPO'd at maybe 20 something dollars, maybe more, between 20 and $40. I know that's a big range, but I don't remember. And I was very new to investing at the time. I didn't know my left from my right when it came to investing. Today, Snap is worth $7. There's not enough dollar cost averaging that I could have done to have an advantage of buying the IPO when it came out. So the lesson I learned was 1, do not chase fad stocks. 2, do my research and understand what the company's doing. And 3, cut my losses early. Let that be your lesson. Understand what's going on underneath the hood of these companies before you get into them. And just because someone on the internet say that they're good, they're not necessarily always good. You have to actively manage and be very calculated when it comes to doing this. So we love the idea of increasing our exposure and actively managing our portfolio. And in doing that, if done right, you will see growth quicker than what you will see in your traditional 401k. And I think it's absolutely amazing that you establish your foundation and then you start investing and growing your wealth that way. And now you have the opportunity to take calculated risk and grow your income a little bit faster and have money available to do some of your shorter term goals that you may have. Now that we've gone over the 3 buckets of foundation, growth, and fun, I want you to know that there is no better time to start than today. Well, actually, yesterday, but yesterday has already passed. So start now. Like, what are you waiting for? I want you to make your bread and butter budget and identify what it is that you need to live off of so that you can start allocating funds to your growth bucket and eventually your fun bucket. Don't forget to like, comment, and subscribe. And I will see you in the next video where we discuss the 5-minute daily habit that will help you keep track of all 3 of these buckets.